Hello, everyone, and welcome to Schwab Coaching. My name is Cameron May. I'm a Senior Manager of Trading and Derivatives Education here at Schwab, and this is Selecting an Option Strategy. And on that topic, I was taking a look at the Options Clearing Corporation site today. I was just curious, how many total option strategy are out there? And now I actually know of dozens and dozens and dozens. According to the OCC, they had 45 on their site. Now, I think it goes way beyond that. So how does a trader select a specific strategy out of dozens to choose from that fits closely with their outlook for market conditions? Well, I'm going to walk us through three example questions a trader might ask themselves as they're attempting to do just that, narrow that field of strategy candidates down to just one or at least a handful that seem suited to the way that they view the markets right now. So I think it's going to be a great discussion. Before we can get to any of that, though, let me first of all say hello to everybody who's already chatting in. Great to see so many familiar names. I'm filling in today, but I do recognize most of the people as I look out there in the chat. Hello there, Janelle and Chris, Richard, David. Let's see, I'm going to scroll up here a little bit, see who else is here. We have, so far it looks like you're the chattiest ones, but thanks for being here each week. We definitely appreciate your attendance, your contributions to these discussions. If we do have anybody in the live audience that happens to be here for the very first time, I want to welcome you as well. And if you're watching on the YouTube archive after the presentation is concluded, enjoy the recording. That's a great way to watch these webcasts, but be aware that you're invited to join us in the live stream. If you'd like to be here, this is a Thursday webcast series. We kick things off promptly at 4 Eastern time each Thursday. I also want to let everybody know that my great friend Kevin Horner is hanging out in the chats. Kevin's going to be keeping an eye on your questions as they roll in. He's going to be addressing any of those that I can't seem to get to during the presentation. So thanks for having my back there, Kevin. And Kevin and I would also like to issue an invitation to everybody listening to follow us on social media. It's a great place to connect with your favorite presenters in between the live streams. You can find Kevin on X at Kevin Horner CS is his handle there. I'm also on X at Cameron May CS. We're both very active there. I also want to let you know that as of just a month ago, you can now follow me on LinkedIn as well. So you can go to linkedin.com/in/Cameron May CS. But let's get into this discussion of narrowing down a huge field of potential strategy candidates using three big questions. All right. Now, as we do, of course, options trading includes risk. So bear these important disclosures in mind. Other approaches to trading and investing also carry risk. But options carry a high level of risk and are not suitable for all investors. The information here is for general informational purposes only and should not be considered an individualized recommendation or endorsement of any particular security, chart pattern, or investment strategy. Schwab does not recommend the use of technical analysis as a sole means of investment research. Investing involves risks, including the loss of principal. And any investment decision you make in your self-directed account is solely your responsibility. All right. So with that said, let's set an agenda for what we're going to be discussing today. First thing that I want to do is just start off with a recognition that we have lots of different option strategies to choose from. So how do we narrow the field? Well, I've compiled a list of three big questions that might assist a trader with narrowing that field of strategy candidates. So I'm going to be proposing these questions one at a time. I'm going to be asking for your feedback on how you see things about the markets. I'd like you to be thinking about this. How might you progress through this series of questions? And then we're also just going to apply those questions to current market conditions. Hopefully that'll help us narrow the field. We'll select a strategy and we'll place a trade. All right. So that's how we're going to do it. So let's go right to the Thinkorswim desktop platform. And before I spoil anything, let's talk about the three big questions. I'm not going to tell you what the answers might be. We'll explore those on our, together, looking at current market conditions. But here are those three questions. Let me turn on the bold function here so it's a little bit easier for everybody to see as I write these out in the scratch pad. Question number one is, as we're about to place a trade, maybe a trader might want to pause to consider, well, for whatever time frame I'm intending my trade to last, do I think the markets are more bullish or more bearish? Because I think just about every veteran trader or investor here could recognize that no matter how good we are at a strategy, if we apply the wrong strategy, or even the right strategy, but at the wrong time, markets can just wipe that strategy out. On the other hand, even if we're not terribly good with our timing, if the markets are cooperative, they can help to erase a lot of those timing mistakes. So question number one is, are we going to do a bullish a bearish or a neutral strategy, not neutral. Let's get this spelled correctly. There we go. That's question number one. Question number two is, are we going to buy or sell to enter a trade? Now, you might think, well, don't we always buy to enter a trade? No, nope. For example, if we're bullish on the markets, we might buy calls or we might sell puts. Both of those are bullish trades. So what are the market conditions right now? Do they appear to be more bullish or more of a buyer's market or more of a seller's market? Now, final question here relates to reward versus probability. With options trades, there's typically a trade-off here. The trader is selecting either strategies that carry a very high reward potential, but typically a lower probability of success, or they might choose high probability of success, but those strategies typically are associated with lower reward for being successful. So is the trader's priority on reward or probability? We get my cursor out of the way so you can see what I'm doing here. There we go. So those are our three questions. So I want to go to question number one. Go away, the bold. There we are. I want to answer this question. And so before this is where I was saying I don't want to bias the viewership pool here. Let me ask you, if you were to plan a trade, let's just say it's a 1 month trade, right? Looking out a month ahead, third week of November to the third week of December, does it appear to you that the markets are more likely to be higher a month from now or lower a month from now? Could be an important question, right? So Janelle says bearish in this market. David saying, I agree, Janelle, with those bearish engulfing candles, downward trends, breaking through moving averages. Interesting. Okay, let's go have a look. Let's go have a look what's going on with the charts. I've prepared a few drawings on the chart. And who was it that said, I saw this come in the chats, lower high is in, or lower low is in. I know I saw somebody. Somebody said that. Anyway, let's talk about this. So over the course of the last, 6 months or so, if you've been attending my webcast, you know that we've been keeping an eye on a trend line here. And for a long time, the markets, the S&P specifically, has been hovering above that upward sloping trend line. And for some trend traders, they might be keeping an eye to see if there are any new developments regarding that trend line. Do we ever break down below that? Or might the markets just continue to go higher? And just over this last week or so, prices actually have broken down below that trend line and closed below that trend line. So that might be, for some technical traders, a sign of maybe there's a shift from what has been an extremely bullish market to maybe we're not so bullish. Maybe we're even bearish. Now, another way that some might view this, and this is looking at, and Jeff says it depends on the time frame, and I think that plenty of people would agree with you there, Jeff. Do we have lower highs and lower lows? Well, if we look at the short-term cycles that markets and stocks tend to go through, typically lasting a couple of weeks to maybe a month or a month and a half, those cyclical peaks have actually been coming down. So here we hit a peak, sold off to a low, rallied up to a new peak, sold off to a new low, up to a third peak just today. And even today, we've gone from maybe even a cyclical high to a cyclical low in a single trading session. That's what can happen on those big candles. So for some who are looking at things in the very short term, they might see lower highs with, could we make an argument now that we have lower lows and maybe even a third low? There's a possibility. So I think that a case might be made. Now, this is not to say that definitively going forward, the markets are going to be bearish. No, but for some, let's say that our hypothetical trader, in trying to make this decision, thinks that maybe for the next month at least, maybe things look bearish, right? Somebody pointed out a big bearish engulfing candle. There is a big bearish engulfing candle. Typically, we'd look for bearish engulfing at the top of at the top of an up move, rather than here where this one appears, looks like it's at the bottom of a down move, maybe just an extension of a down move. So not a real traditional bearish engulfing, but still Not a great looking candle for the bulls, right? So let's just say that our trader, in addressing question number one, maybe they're looking out to that next expiration cycle and they're thinking, maybe it looks like we might be more bearish than bullish. So let's say that's our answer. Here's what, now, whether you agree with me or not, addressing that question, though, has just made a huge leap forward in narrowing the field of potential strategy candidates, because some strategies are bullish, some strategies are bearish, and some strategies are neutral. And we just took the neutral ones and just sort of shuffled them off the side of the desk for a minute. And we took the bearish and we shuffled those off the side of the desk. And actually, Eric just asked a great question. This is why some traders may have a different look at things. They might say, okay, sure, we've gone down for a month or maybe 4 weeks, but we are in holiday season, and that's traditionally a very bullish time of year. So maybe this is just a setup for a rally. Well, great point there, Eric. I'm not saying that every trader should come to the conclusion of bullish or a bearishness right now. But and always these webcasts are for educational purposes only, right? But yes, there are different ways that we might view the market. So I leave it to the trader to address this decision however they feel most appropriate. But let's just say that I did the wrong thing here. I unhighlighted the wrong one. Let's say that we've concluded that this trader is going to be bearish. Well, so we've taken neutral off the table. We've taken bullish off the table, to correct what I said earlier, and we're left with bearish. Now, that has pared down that list of potential strategies dramatically, but there's still a good number that are left to be chosen from. Well, some of those bearish strategies are going to be built on buying options, and some of those bearish strategies are going to be built on selling options. So here's question number 2 for you. Is it more of a buyer's market or more of a seller's market for options traders right now? What do you think? What do you think? Go ahead and chat in. Nobody knows exactly the right answer, right? We have where things appear to be right now, but tomorrow could be very different in either direction. So there's not a right or wrong answer here. You don't need to be, if you prefer not to answer, that's fine. Chris and Janelle are saying seller. Okay, well, how do Chris and Janelle come to that conclusion? I can't read minds. But here's one way that traders might address that question. That is to bring up a different chart. And in this case, we're going to use a symbol VIX. Janelle says, doesn't selling cause the market to fall? Well, yes, but for selling options, no, that doesn't cause the markets to fall, because we might be selling calls, we might be selling puts. Those are not influential net necessarily on what direction the markets are taking. But if we look at the volatility index of the S&P 500, for some traders, they use this as a general gauge of the pricing of options. And sellers of just about anything are pretty keen on prices, right? If you're going to sell your house, do you want to sell when prices are really high or sell when prices are low, or do you just not pay attention? When you sell a car, do you like to sell when the model is popular, when nobody wants it, or do you just not care? Well, yeah, for some traders, for a lot of traders, they tend to like to check the general pricing of things before they sell or before they buy. So the volatility index of the S&P 500 is historically seen to be closely correlated with the general pricing of options. When we see a spike on this chart, it generally means that options prices, not entirely across the board, but very broadly, are higher than where they've been historically, because this is a chart of the anticipated volatility of the S&P 500. And typically, when traders expect greater volatility, options prices go up as a result. That's because volatility looks like risk to hedgers, so they might buy more options or trade more options in their efforts to hedge their portfolios. Volatility might look like potential for option speculators, so they might be trading options more aggressively on markets that are moving more rapidly. But in any case, a combination of those factors and others lead to the bottom line that when the volatility spikes, that tends to mean higher prices on options. And for those people that are looking to sell when prices are high, guess what? As we look at today, we can say with a pretty high degree of certainty that a lot of options prices out there right now are higher than they've been in the last 6 months, with the sole exception of a few hours back there in October. That's it. Yeah. So some would call this high volatility a seller's market. And that might incline them to how they answer this question. Now, it's not to say that just because volatility is high or low, we should be selling or buying. Nope. It might just be part of the puzzle. Some traders still might prefer to buy options. They just recognize they might have to pay a little bit more right now for those. Others maybe like to sell even if volatility is low. But let's just say that our trader here is bearish and they're looking to sell some maybe highly priced options. So that might add up to, well, let's talk about just bottom line, what are some bearish strategies? Well, we can buy puts, or we can sell calls, or there are lots of variations on those themes. Both of those are bearish. Selling calls, though, is more in alignment with this decision. Selling seems to be, well, it seems to be maybe more of a seller's market. Now, before I go on to our third question, how could I be proven wrong? I can look at this and say, well, prices are higher than they've been in the last 6 months, so it must be a seller's market. When do we feel bad about selling? Well, if prices continue to climb, is it possible the volatility could continue going higher? Absolutely could. Yep. But generally speaking, it hasn't tended to go much above this except for rare short bursts. You can see we've been about to this level a few times over the last 12 months, just not very often, and this doesn't typically go higher than that. All right, so selling calls is how we're going to structure our strategy. Now, we could just sell a call. Problem with just selling a plain old call is that comes with unlimited risk. Let's say that our trader prefers to define that risk. Let's sell a bearish call spread today. All right, that is a bearish trade. It's built on selling. Now we have a final question to address here. Call spreads are neither inherently high reward, nor are they inherently high probability. The trader can actually choose between those two and then structure their trade accordingly. So somehow we need to make a decision to answer this third question. Are we going to structure this call spread to have a high reward potential, or are we going to structure this call spread to have high probability? And you probably want me to show you a chart that shows how to make that decision. This sometimes just comes down to the trader's preference. Some traders feel like their timing is really good and they want to dial up the reward potential for that particular skill they have, and so they might lean toward reward. Other traders would prefer to back off a little bit, ease off the gas, go for higher probability, and surrender some of the reward potential as a result. So let's keep this one. Let's just sort of park this one for a moment. I want to revisit that, but I want to look at our example stock for today. So I've already gone out and looked at some stocks. Guess what? I looked for something that looked bearish. Okay. And one thing that might catch the eye of some technical traders is what's happened here with Microsoft recently. Now, I'll get to the chart of this in just a moment, but there are some other potential pre-qualifiers when selecting a stock for trading options. For example, maybe price per share plays a role. Also, liquidity can play a big role. Illiquid stocks tend to have illiquid options. You've heard me say that before. It's true. So maybe for some traders, they like to trade only highly liquid stocks, maybe that might have a little bit narrower spreads on the bid and the ask prices on the options. So those were pre-qualifiers, and they were considerations in selecting this stock. Now, this is kind of a higher price stock. We're going to look to define the risk of the trade anyway, to the extent that it's possible for us, but price can play a role. But now getting to the chart, what's happened on our chart? Well, for some technicians, they might notice that Microsoft rallied up to $555 and then sold off hard. And then it attempted another rally and it hit about $555 and it sold off hard again. We have peak number one right there. We have peak number two right there that actually carries a title, an official name in technical analysis. What do we call that? That is a double top. Yep. And Chris points out this is a double top. When we see 2 points like this, the trader might be on kind of high alert. Oops, looks like our stock is struggling to go any higher. When might they determine that it looks like this is reversing the trend of the stock overall? Well, we look to the lowest point between those 2 peaks. And if we get a break below that, some traders will see that as a reversal signal. This stock is getting ready to go down. Is it a guarantee? Of course, it's not a guarantee. But let's just say that's our technical evidence here. All right. We've broken support. We think this is going to go down. It's a bearish apparent setup. We're going to use this bearish apparent setup to initiate a short call trade, a bearish call spread. So how about we do this? I haven't looked at the numbers just yet, but with the apparent price floor right here on 495, I'm going to round off just about $1 there. High price stock, we're only shaving off a fraction there. Let's call that 495. So what if we structure our trade here? But we're going to keep that resistance in mind, because let's address this final question. For some traders, they might look at this and think, well, a break of a support line on 2 very prominent recent peaks might mean this stock is about to go for a hard run down. And if it's a hard run down, and I'm pretty confident about that, maybe I'll structure my credit spread to offer a large reward potential. Now, on the other hand, a trader might say, well, yeah, okay, it's broken that support, but it may go down. It might not actually go down. Maybe it starts to rally a little bit. What I might do is just back off, ease off the gas. Let's set up a trade that has a higher probability of success. Might not offer as much of a reward, but for some, they emphasize probability. I think for today, let's go for that higher probability. Okay. Jeff says, look up the ATR. Is there something going on with the ATR there, Jeff? We can see it's probably pretty good size. The ATR is going to look over the last 14 days and see how much Microsoft tends to move up or down in an average day. And looks like that might be what, $14, $15. I'll take a quick peek. Let's come up here. Look at our ATR. It means our average true range, but basically candle's not the right way to say it. It actually includes the overnight gaps. So it's the distance traveled in sort of a 24-hour period. But let's add that to our chart. Click apply and click OK. All right, it's closer to $11. So over a 24-hour time frame, it looks like Microsoft's moving about $11 in a given day. Okay. But let's take that off now. And let's plan and place our high probability trade. So that's what we're going to do. Somebody's out there screaming at me saying, no, do a high reward trade. Well, today we'll talk about probability. If I come back and fill in another webcast, we'll switch next time, talk about reward. Okay. So how do we do that? Well, with a credit spread, when selling the contract, the seller is typically looking for the contract to expire worthless. And a way to dial up that probability is to deal with out of the money options, where they're already where the trader needs them to be as they cross their expiration finish line. So let's go maybe out here to the 19th of December. That's sort of the time frame we've been eyeballing, out here to the 19th of December. Let's say that our trader thinks maybe the stock is bearish. Maybe the markets might see a little bit of recovery. But even if they do, as long as Microsoft is not below 490, let's do 495. I'm going to draw a box around this to show where we'd like this to be. 495 is right about there, close enough. So this is where we're looking for our stock to go, somewhere in there. All right. Let's go to our trade tab and let's look at what the 495 calls are selling for. So if we're to sell, let's say, the 495 19th of December calls, here's going to be our example trade. This is a bear call spread. Bearish because benefits of the stock goes down, it's constructed using calls, so bear call, and there's going to be a spread between the two strike prices we choose, one being maybe 495, the other one being maybe 500 or 505. So there's a difference between those in strikes, so bear call spread. So let's look at maybe selling the 19th of December, 495 call, and that looks like that's trading 785 to 805. Let's call it 795. Now, could we just halt our trade right there? Could we just place that? Is that a bearish trade? Yep. Typically, when selling a call, we prefer the stock could go down because someone has the right to buy shares from us for 495, and they're less and less likely to do that if the market value of those shares is lower. In other words, they can buy the shares somewhere else for less. So we prefer for the stock to go down. So it fits that category. It's built on selling. So, yep, that's number two. And it's a high probability of success on this trade. If I just do that call right there, what's the probability of success in percentage terms? How can we see that as an estimate? Well, we might look at delta. Delta can tell us how much we might make or lose on a $1 move on a stock for each strike price, but it might also show us the probability that a contract expires in the money, retains some value at expiration. So there's only about a 35% chance that this 495 call will be in the money at expiration. In other words, there's a 65% probability that it's just going to expire out of the money. So that is a bearish selling strategy that has a high probability of success. A potential issue with just selling just this call is someone has the right to buy shares from us for 495. We don't know how much we might have to pay for those shares. If the stock goes rocketing up, we might have to buy the shares at a higher price and sell them at 495. If it keeps going higher, we might have to buy it at an even higher price and sell it at 495. There's an unlimited risk to selling what's known as a naked call here. So let's not leave it naked. Now, some traders are totally comfortable with that. They want to keep the full credit that might be achieved here. So they go ahead and sell the naked call contract. But let's cover this one. How about let's go $10 up. We go up $5 and spend about $620, or we go up $10 and spend maybe $480. Let's see. Let's look at maybe buying the 19th of December, 505 call. How much might that cost us? I said it was going to be maybe about 480. Yeah, let's be generous. Let's say we can get that. 480. Yeah, let's not be that generous. Let's say 485. Okay. What does this do for us? Well, it conceptually puts a cap on the theoretical risk of this trade. Someone now they have the right to buy shares from us for 495, but we have the contractual right at the same time for the same duration to buy shares at 505 if needed. So if this contract gets assigned, we now know, well, at least we can exercise our right, buy the shares at 505, sell them at 495. That would sting, be a $10 loss, but it's not unlimited. That's the value that we're achieving by spending the $4.85. Okay, so now I want to go through some other numbers here and go ahead and place our trade. But before I do that, let me first of all say, hey, there is a survey in the chat window right now. So we don't always get surveys. So when they happen, if you do me a favor, fill it out, that'd be fantastic. So for those of you who are here in the live audience, there's a survey link that's been added to the chat window. If you could click on that survey and then just give me your honest feedback when the webcast is over, that would be fabulous. It's just 2 multiple choice questions, a comments box and a suggestion box. And if you take the time to fill out that survey, I always take the time to read through that data. I read the comments, and it definitely helps. All right. And Jeff, thank you. Jeff says I'm the best instructor. Come on, Kevin's listening. Anyway, now we're all great. I think everybody knows that, but thank you. Appreciate that. Anyway, let's look at if we spent the 485, but we've collected 795, what's net left in the account after all this is said and done? Well, $7.95 collected minus $4.85 spent means that our net credit on this trade is $3.10 if we're able to fill at or around those prices. Okay? That's also theoretical maximum gain of this trade. $3.10. What's the maximum loss of this trade? Well, we already determined, here's the calculation here. If the contracts get assigned, if this 495 gets assigned, we have to sell shares for 495, and we have to buy those shares for 505, that's a $10 loss. And we can subtract from that the original credit that was sort of partial compensation for that exposure, but really the bottom line theoretical loss here is $6.90. So you might immediately see the math here. Wait a minute, there's about $2 of risk for every $1 of reward the way that we set up this trade. Yep. Did I go for high reward? No, I didn't. That was a very deliberate decision. However, did I accomplish high probability? Absolutely did. Yep. This trade, as of right now, let's double check it. Yep, still a 35% probability of even the short contract expiring in the money. There's a 65% probability of reward in this case. So there's a 65% chance that we might make 310. What's the probability that we might lose 690? Well, we go to the 505 strike, look at that delta. There's about a 24% chance that's the outcome. That's going to leave a little bit left over. 65 plus 24, by my math, is 89. There's a missing 11% here somewhere. So let's talk about the potential outcomes. So this is where we'd like our stock to be as we get to December 19th. Right up here, let's go up to 505. That's going to be right around there. Drawing another box. Closely as I can. There we go. This is where we don't want to be. This is a bearish trade. We don't want it to behave bullishly. Okay, so this is the danger zone, because what happens? Well, if we go from where we are right now and we go down and we hit expiration, let's say we're down here. Stock's at 450. Someone has the right to buy shares from us for 495. Are they going to do it? Almost certainly not. They could get a wild hair, and they could do that if they want to, I guess. But almost certainly not. They're just going to say, Cameron, I don't want your shares because I can buy them myself for 450 on the open market. So this just expires worthless, and we keep it. The 505 call, we have the right to buy shares for 505, but we can buy them elsewhere for 450. This contract just expires worthless. So the net between those two is we just made $3.10. Realized gain if that's the outcome. That's why this is the green zone. As long as we're below 495, that is probably the outcome. I always have to say probably because somebody can get a wild hair and exercise even an out of the money contract. But what if this happens? What if our stock rallies up and we're up above 505? Well, now this trader is getting a discount. They can buy shares for less than market value, and they do it with very rare exceptions. So they buy the shares for 495 because the shares are up here, let's say at 520, and we say, oh, crud. All right, I'll buy the shares at 505 because that's better than buying at 520 and selling at 495. So we buy at 505, we sell at 495. That's a $10 loss. We get a little bit of compensation, a little consolation prize here of $3.10 because that's the credit we got up front, and that would be a realized loss. So this is best case scenario theoretically. This is worst case scenario theoretically. I say theoretically because there's another scenario that might play out. Where's the missing 11%? Well, there's a gap between max profit area and max loss area. That's in between the strikes, in between 495 and 505. So let's say, what if the stock rallies, behaving bullishly? That's not good, right? Let's say it goes up here and it winds up at 500 bucks at expiration. This trader's still getting a discount, so they buy our shares at 495. We would have to overpay to exercise our contract, so we don't. Instead, we just buy the shares at 500. Actually, we don't necessarily yet. What may happen here is we just allow our long contract to expire worthless, and we wind up selling shares for 500 bucks or for 495 that are worth 500 bucks, and we have an unrealized loss of $5, and we're now short shares of stock. A short position on stock is exposed, especially if the stock continues to climb. If it goes down, actually, that could theoretically pretty quickly erase the loss on this option trade. If it continues to climb, though, it can compound the losses. We sold shares for 495, and if those shares go up to 550 before we decide to buy them back, we could lose a lot of money, and even more than that. Anyway, so yeah, there is that possibility. If we hit expiration in between our strikes, or if through any other mechanism, the short contract is assigned and we decide not to exercise the long, we might wind up short shares of stock with unlimited risk potential in that short position. So that's where that other 11% is. So now that we understand how this trade may play out and why we prefer for the stock to be down here, let's go place our trade. I want to at least walk through it. I'm not actually going to send it off because I'm just filling in today and I wouldn't be around to follow up on it with you next week or next month. But how do we place this trade? Well, if we want to sell the 495 contract, we click on the bid price. And that brings up a seller. If we want to buy the 505, let's just go back up here to our option chain, hold down the control key on our keyboard, and click on the ask price to create a buy order. And that puts in order to buy, well, to sell 10 of the 495s, buying 10 of the 505, and we can just change the quantity to whatever we see fit here. And assuming, let's say we can get that, how much do we figure out our credit was? Possibly, yeah, 310. Okay. That again. Let's say we put in a limit order of 310. That means that's the minimum credit that we'd be willing to accept. If it's available, trade fills. If it's not, the trade just expires. And we can confirm and send that order. But that's how the order might be built. Let's just talk through this. I'm not actually going to send this off, but here we're thinking about selling 5 of these 495, 505 bear call spreads. Looking for a 310 credit across 5 contracts. That would be $1,550 of reward potential. That would be $3,450 of loss potential. High probability of success, but a big punishment for being wrong is the way these trades work out. And there is a commission to be paid. So I could send that off. That's it, guys. We've talked through what I wanted to discuss. I wanted to lay out this case that pretty much every options trader is confronted with. When they're selecting an option strategy, they have dozens and dozens and dozens to choose from. So how do we narrow that field down? So we might ask ourselves a series of 3 questions. Bull, bear, or neutral, buy or sell, and then reward and probability. And those can really help inform the trader in making a selection that's tightly aligned with the way that they view the markets and the way they prefer to trade. All right? Janelle, you like that? Jeff says, is there such a thing as an OCO order on that type of contract? There can be, Jeff. I'm not going to do it here today, but yes, the trader can conceptually set up, let's say, an order to buy back if the trade is failing. At the same time, attach an order to buy out if the trade can be purchased at a lower price and if it's succeeding. Yes. All right. But I'm going to leave that as a point to make and investigate another day when we have more time. But I hope that you found this helpful. I wanted to leave the emphasis on the selection process. It's just an example process. It's not the way that everybody approaches this, but I think you can see the logic of this sort of an approach. JDLMI says, sorry, I'm late. Is this a bear trade? It is. Yeah, bear call spread is what we did. Now, if you need to go back and revisit the archive for this session, It should be available shortly. This is one of those webcast series where we try to get these videos posted promptly after the conclusion of the live stream. So that brings up a point, though. We have lots of resources available outside of the live streams, and you need to make sure that you're aware of all of those. So the first one is, if you haven't subscribed to our Trader Talks channel on YouTube yet, do yourself that favor. Do that right now. Go down, click on the subscribe button. Our Trader Talks YouTube channel is where we host, that's where we house the playlist for completed webcasts. So you can find our playlists right here. You can join live streams right there. Kevin and I would also like to issue an invitation to everybody watching. Best place to connect with your favorite presenters in between the live streams is on social media. So you can find Kevin and me on X as an example. You can find Kevin there at Kevin Horner CS. You can find me on X at Cameron May CS. Give us both a quick follow. It doesn't cost anything to follow us on X. But I post regularly on X, and if you reply to one of my posts, I try to reply right back to you. A lot of you already do that. You know who you are. You can vouch for me. I keep an eye on these things. But another thing that you can do now, as of about a month ago, is you can follow me on LinkedIn. So let me bring up my LinkedIn profile. There it is. So typical LinkedIn prefix is linkedin.com/in. And then just throw on /Cameron May CS, and that'll take you right to my profile. You can follow me there. You can see what I have to say in between the live streams. You can comment, and then I'll just reply to those comments. Okay. Someone's asking about managing the trades. So I'm not going to get into the management of trades. However, you may want to join me in my other options strategies discussions, where now, do you know how to find us? If you want to track us down, you want to see our calendar, you can go to the posts right here. Let me show you this. So if you're already following us on Trader Talks, go to posts, scroll down, there's our calendar, and you can see like my other webcast series. This one might be one that you'd be interested in, is my Wednesday webcast series at 12 o'clock Eastern Standard Time called Managing an Options Portfolio. All right. But in any case, guys, actually, my apologies. I need to get this updated. Join me for long verticals and diagonals. Managing Options Portfolio has been passed along. I now do deliver the Getting Started with Thinkorswim. All right. But anyway, guys, thanks for giving me your time today. Kevin, thanks for helping out in chats. Thanks for filling out the survey, everyone. I will look for you in a future webcast. I'll also look for you on X and on LinkedIn. But whenever I see you again, until that moment arrives, I want to wish you the very best of luck. Happy trading. Bye-bye.